So in previous class, we were discussing about particularly the types of projects in SAP implementations. Whenever we talk about types of projects, we understood that there are various projects, maybe just to know what kind of projects usually we come across, something like implementation project. Whenever an organization starts implementing SAP in their organization, we call that as implementation project. It can be end-to-end implementation. Generally, we call that as an end-to-end implementation. Then other projects are called a rollout projects. And we also have a requirement where we need to thoroughly test each and every configuration that we are moving to the production, that you call it as a testing project. And support projects, once you've done with all the implementation and hand over your system to your business, then from there on, they need support throughout the life. That is called a support projects and migration projects. We spoke about this at a high level. In upcoming classes, we are going to take each and every project for us to understand. We'll start with implementation project. We'll understand how implementation happens, starting from the day one. As a consultant, what are the activities that you will be handling? We will discuss all of them in detail. Okay. Now, for us to understand the further, yesterday we were talking about whenever we wanted to implement FI/CO module particularly. FI is all about your external financial reporting. Whenever we talk about external financial reporting, which means the companies wanted to bring their financial statements from the system. What are the basic and important financial statements that we need to extract from ERP system? That is your profit and loss account. Even before profit and loss account, you should be in a position to extract trial balance first to compare and confirm the accuracy of your all the accounts that you performed or the transactions has been entered into the system. Then you need to prepare profit and loss accounts, and you need to make sure you need to prepare a balance sheet as well. So these are the basic things that we prepare. To prepare this, ERP system is going to help you how you extract, how you prepare the system for all this. So for that, the basic thing is if I want to understand or prepare a financial statement, first thing you need to understand accounting cycle. That is what yesterday we wrapped with. We are going to start understanding now with the accounting cycle. Whenever we talk about accounting cycle is something where all your financial transactions begin. Where does it begins? Where does it ends? That is what we need to understand. Now let us start understanding if I want to prepare financial statement or even before preparing a financial statement, what is the most important thing that we talk about? We talk about the transactions happened in a business, the summary of all the transactions, whatever has been happened, which has a monetary value. If there is no monetary value, such transactions we are not going to record in our financial books. Only the activities or the transactions that can be measured in a financial terms are going to be recorded. Now let us understand what are the transactions, some few transactions. Consider your own business or assume any other business. Let's say you are starting a fresh business. What are the activities that we perform in a business? Let us understand those activities and try to convert them into financial transactions wherever they are applicable. Can you guys help me sharing your experience about whenever you start any business or whatever the business that you have seen, what are the basic transactions that we start with? What are the basic transactions happens in any business whenever we start any business? Anybody would like to add or share your understanding about it?
Cash in hand.
Cash in hand. You need a cash to start the business. Okay. You need a cash. What else? If you have a cash, is that sufficient? Everything will happen automatically.
No, we require materials to,
we need a materials. Okay. What else?
Hi, Shima. For business, you can do the purchasing.
Purchasing, okay.
Yes, accounts payable, receivables,
Accounts payable, accounts receivable, okay.
general ledger.
Okay.
Sales.
Sales we talk about, okay. Okay, now let me put all this wherever there are various things happening. Let's say in certain cases, you don't have activities which you can directly measure in a financial terms. Certain things you can measure, certain things you can't measure. Let's say whenever you talk about cash, which means you are starting a business and you wanted to convert or you need to measure any transaction happened in your business into a financial transaction. If you wanted to measure that, you need to make sure whether that really has financial impact or not. How do you measure or how do you confirm whether that has a financial impact or not? So you need to think whether is there any money is going out because of the transaction, either now or in a later. Some activities or transactions will happen on a credit basis. Now you might purchase on the basis of a credit because you already have a credibility. I think somebody has to go on mute. Sorry, give me a sec. That. Thank you. Okay, whenever we talk about financial transactions, let's say now person X has decided to start his business. He wanted to start his business with $1 million. Now, when I say $1 million, so if you want to convert that in Indian rupees, right, 1 million equals to 10 lakhs. As we have some international participants here, so I'm just using millions and billions. I want you also to get familiar with millions and billion terminology because it is going to be the common usage in a business. Okay, so make sure you guys get familiar with millions and billions. We generally call it as a lakhs and crores. Slowly, you need to understand what do you mean by millions and billions as well without any confusion. Now, person X wanted to start his business with $1 million. When we say that he wanted to start with $1 million, what do you mean by that? So, is there any financial impact in that or not? That we need to understand. Now, as we are going to learn about consulting skill set, you no need to worry about. This is all about your business activities, what they do it. But still, whenever you hear any transaction, you should be able to identify whether that is a financial transaction or not. If you are able to identify, that's more than enough. Now I will start listing out certain activities and see if you can recognize from all the activities that we have already listed here. So I'll list out some more activities where you will understand what exactly the financial transaction means. Now let us understand. Whenever I wanted to start my business, I need some cash. So that in business terms or accounting terms, we call that as a capital. You will bring capital to start your business. Okay. So we'll say that capital introduced. Let me call this in case I wanted to call this in dollars. Let's say $1 million, or sorry. So maybe let me put this 100K dollars. Okay. So we go with $100K. I'm starting today. And when I have my capital, so if I wanted to have some dates, you can have the dates. At this moment, I'm not putting any dates. Assume that all these transactions happened in a range of one particular month. Maybe let's assume that in a previous month. We are in June now. In a May month, these are the transactions happened. Person X has started his business or he was thinking to start. Then he introduced $100K in last month. Once he has that capital, he need to make sure he has to procure some materials in case he is going to deal with goods related activities. If he wanted to sell some goods, he need to procure some goods. Then he need to think about it, whether he need to process something or is he going to be like retailer. He purchase as a wholesaler and just sell it as a retailer. That's a different story. Majority of other businesses, what happens? They will purchase raw materials and they convert this raw material into finished product. We'll talk about this in detail later. What is raw material? What is finished product? What is work in process? And all this, it comes into picture later. But at this moment, so we will talk about it. I need some materials. Either you call it as an inventory, or you call it as a raw material, or you call it as a stock, or it can be a multiple names, but I need some materials. Now let's say I'm going to buy some materials, right? So now let's say purchased materials for, let's say how much? $30,000. Out of 100K, I have spent 30,000 for my materials to purchase. Now I had introduced 100K, out of which 30K I have already spent. Now I remain only 70K with me. I already spent 30K. Now what I need to make sure, if I want to rotate that money, or if I wanted to purchase more goods, I need to think about it. I need to sell it faster so that I'll get cash from my customers. For that, what you need to do, you need to sell the goods. I'll make our transactions very simple so that you will be able to understand how one accounting cycle we are going to deal with. Now, let's say sold goods for, let's say, approximately 50,000. I purchased 30,000 worth of products. Now I am selling the same worth of products for 50,000. So straight away, if you compare this, you will be able to calculate some profit or loss. I invested 100K. Out of 100K, I have not spent everything. I spent only 30K and I sold it for 50K. Now I'm able to make some profit out of this if I calculate. Even before you calculate, if there is other expenses involved, that profit will reduce in this number. At this moment, if I calculate, profit looks like 20K. But you need to understand, I might have incurred other expenses like office rent. And you need to think about office rent, how much you paid it. Now, let's say, for example, I paid a rent maybe 5,000. So our profit itself is very low. So I'll make it as a very low rental expense. Let's see that rent you paid 5,000. Again, you paid a salary of 10,000 for your staff, and for yourself, you need to keep it salary as a 10,000. And now you also had some advertisement expenses where you spent. Now you need to think about advertisement expenses. So let's say this advertisement expenses you spent again additional 3,000. So far we spent approximately 18K here. Out of 20K profit, all expenses gone here. Now you left with only very small amount. Now let's say on top of that, you also purchased some more fixed assets for your business to manage it. Now let's say purchase of fixed assets like your furniture, your computer. Maybe you haven't purchased a building at this moment. You are just paying rent initial months. Later you might think about it purchasing. Now at least you need one computer, you need some mobile phone or a telephone, and you need some table and some other furniture for your customers to have that. Whenever you set up office, you need a minimum basic things. For that, you purchase some fixed assets. So let's say you spend 20K on that. Whenever you spend that 20K, now during the course, I think you spent again you need some stationery also. Stationery, you spend $1,000. And finally, you spend some telephone expenses. I'm just trying to cover the basic expenses and the basic activities that we do in a business so that you will be able to relate it very easily. Now, I spent another $2,000 as my expenses, telephone expenses. If I consider all this, so these are the activities happened. Maybe now let me replace this here. So let's say whatever you have it here, let me move them into the other column. So how do I do that? Let's say, okay. Now these are all in dollars. So let me convert this into currency, $1. Okay. Now I have these many expenses that I have incurred for the month. Now, in a business, this is where a transaction starts with. Whatever you see here, each and every line that I have written is going to be called as a transaction. What do you mean by transaction? So an activity happened with the intention to support your business. Each and every activity is going to be termed as one transaction. That transaction, you call it as a business transaction. Either you call it as a transaction or a business transaction. In each and every transaction that we are talking about, does it involve money? Either it comes into the business or goes out of the business? Yes or no? All of these transactions contains monetary value. Either money comes in or goes out. Any one scenario happens. Everybody agrees. Or any scenario or any transaction in this doesn't contain any monetary impact. Are there any transactions in this which don't have any impact on a finance? No, right? All of them has a financial impact. Now, whenever you talk about financial impact, now those are the transactions which are going to be recorded in your financial book. Let's say at the during end of the month, you think that now you are entering a contract, let's say, with customer that they will purchase let's say 30,000 worth of products in next month. This is a contract that they are entering it. Now, whenever we are entering a contract, can I enter this as a financial transaction or not? Can I enter this as a no, right? Because this is a purely a contract. There is no financial exchange happening during a contract signing. It can happen or it can cancel also. But this 30,000, you can't calculate or you can't measure whether you received it or not. There is no evidence for it also. For all other transactions, there is an evidence. Capital you introduced, there is an evidence. Material you purchased, there is an evidence. What is the evidence that you purchased? You will have an invoice, you will have a goods both. You have a physical goods and you have an invoice as a confirmation. Sold goods. Your goods has reduced and you also receive cash. If it is a credit, but still you will receive later. But for now, your goods has reduced. Now rent, you paid rent, you have the evidence. Salary you are paying to your employees and for yourself, there is an evidence. Advertisement expenses and purchase of fixed assets, you have a fixed assets. Stationery you have in your hands. Everything you have utilized it and you know that in each and every transaction, there is a money either coming in or in. This is called a business transaction. Whenever we talk about accounting cycle, first thing that you need to understand is business transaction. I'll summarize at the end how the cycle happens. For you to get familiar, I'm just trying to add more information here. Let's say now what happens, you have these many transactions happen in your business. Whenever these many transactions happen, what happens? Now you need to understand what happens next. Whenever transaction happens, what business usually will do with these transactions is what you need to understand. So whenever they have this kind of transactions, particularly, finally they need to calculate profit or a loss. That is what we call it as a profit and loss account. Right? If I wanted to know profit or a loss that I made in this business, for that you need to understand how to calculate profit or loss. In generally, let's go with a very layman terms. You don't need to be so much of technical in terms of accounting. Go with a very layman terms and try to understand how do you start understanding this. First thing, let's say if there is any repetitive transactions here, what we need to make sure? We need to summarize them. We need to summarize in the sense, let's say there is a multiple purchases happen. Maybe let's say that purchase of material happened from vendor 1 for 10,000. From purchase of another material from vendor 2, that is a different of another 5,000. Purchase of material from one more vendor, then additional 15K. So in that case, what happens? Let's say this 30K, it is going to change into 10, another 5,000 and 15,000. There are 3 vendors. Purchase of material from vendor 1, vendor 2 and vendor 3. Whenever you have 3 different transactions, you need to summarize all of them into one single purchasing activity. That is what we need to check. Now let's say that you have a 3 different transactions happening here. So let me keep this way so that you will understand. Now you need to summarize that. Whenever I say sold goods for 50K, it might be a multiple customers again. It's not just one customer. Generally, for customer 1, let me say instead of for goods to customer 1, customer 2, customer 3, and customer 4. There are multiple customers involved. Instead of 50, let me say this as 20,000. Sorry, 20,000, 10,000. It has become 30 now, and 5,000 and 15,000. Put together, it is a 50,000. Now, these are the other set of transactions happened. Now, let's say what generally we do, we need to prepare summary of all these accounts. In finance and accounts, those who are already familiar with this, those who started preparing your financial statements, you might understand how do we prepare this, right? So whenever we are preparing, in the first thing, whenever you look into this business transactions, what is the first step that we do to prepare our final financial statements? Even before you prepare final reports, or even before you prepare your profit and loss account or a balance sheet, what is the next step that we do it? The most important thing that we need to take care here.
Trading account.
Trading account we need to prepare. So even before trading account, is there something that we need to prepare? If you go back into your basics of accounting, first thing what we will do, like I mentioned earlier, we need to summarize all this. First, you will create your ledger balances. You need to summarize your ledgers. You prepare a ledger balances first. Let's say how many accounts are impacting here. Let's say in this case, there is a capital. I will say capital, one account. The next account here, it is the purchases. Though there are multiple vendors, this will become your sub-ledgers. Vendor 1, vendor 2, vendor 3 are sub-ledgers. From all the vendors, we are going to put one summary number that is called purchases. Your purchases will become a main ledger. All the vendor numbers, vendor account wise, that will become your sub-ledgers. Now let's understand the customers. I have a multiple customers. Out of multiple customers, who are those multiple customers? You again summarize them and say which is the sales. Just one GL account here. And you will have a multiple customers. Though you have a multiple customers, you will have only one sales put together. And rent. Rent is another expense. You will have the rent, you will have a salary and advertisement expenses and fixed assets. Fixed assets, and you have a stationery and telephone expenses. These are the total GL accounts which will impact. Generally, whenever you call a purchases, you call them either accounts payable account. So sales, all it will become your accounts receivable account. Majorly, you will call it as accounts payable account and accounts receivable account. But others are all very expenses. Now, let us try to understand which account is going to have which kind of impact. Now, whenever you introduce capital, what happens with the capital? So how do you understand this capital? If I wanted to write in the form of a journal entry to understand the financial impact. In accounting world, we always call that as every financial transaction will have a dual impact. What is dual impact? Either it will have a debit and credit both the impact. Any transaction. Both the transaction has to match. If the debit and credit both has to match whenever you perform any activity. Okay, now let us understand. Whenever I introduce capital, what is the journal entry for my capital introduction? Let me put this list down. We'll come back to this. Now let me understand my journal entries. Now I'm introducing capital. What is the journal entry for this capital? Anybody wanted to give a shot?
Debit comes in, credit goes out.
Debit comes in, credit goes out. Very good. In this case, what is coming in?
Capital, cash coming in.
Capital.
Capital is coming in.
Debit.
Okay. Capital coming in and what is going?
Cash.
Cash is going out. In that case, can I say capital account to?
Capital account debtors to cash account.
Okay, so that's perfectly wrong. Everybody has said incorrect, but I'll tell you why it is incorrect. Okay, so this is where we need to have.
Capital.
Yes. Here, whenever we introduce capital, which means as a business owner, you are receiving the cash. Owner is different, and the person, whoever is giving the money, is different. It might be your own money, but still you need to treat that as a separate from business. Because as a part of your accounting rules, we always talk about business entity concept. So separate entity concept. Either you call separate business entity or a separate entity concept. So whenever we talk about it, business is separate from the owner. Owner, whatever you are introducing capital, still you need to treat that as you are getting from other person. In that case, what happens? You are receiving cash. You completely treat about business only. Don't think about a person, what is happening to the person. Only think about in the business terms. Let's say KNR Ignite Solutions is a business now. KNR Ignite Solutions is starting a business. Now KNR Ignite Solutions receiving a cash. Now I'm receiving a cash as per accounting principle. So whenever cash coming in, debit what comes in. That is called it coming in. I'm receiving a cash here. Debit what comes in. How much cash I am receiving it? That is called that I'm receiving it. Let's say 100K is what I'm receiving, $100K, right? So what gets credit here? Now
Equipment.
your capital account gets credit. Capital account get credit. So because you are introducing a capital with the same amount. Now don't worry about sign at this moment. We'll go with a plain example to make you not too confused. No. Okay. Now I introduce the capital for 100K. Debit what comes in, credit what goes out. There is nothing going out, only debit what comes in. Now my debit and credit both matches. There is no difference. That's another fundamental rule that we need to learn. Now, capital account is a different thing that we will come back later. So how to treat that? For now, cash, I understand wherever there is a direct cash involved, think about it, whether it is a coming in or going out. If something is coming in, like a cash or asset or anything else coming into your business, then that you treat it as debit. Now, cash is coming in, 1 lakh rupees I received to start my business from another person for a KNR Ignite Solutions. Okay. Now, person whoever given this cash is a different. Maybe if I introduced as a owner, still I need to treat myself as a different from the business. I can't say everything is same. Now, that is my first journal entry. Now, the second journal entry that I need to think about it, purchases. Whenever we do these purchases, generally we prepare T accounts for each and everything. So let us not go deep about how to prepare T accounts and everything. I'll make it very simple and straightforward for you to understand purchases. Whenever I purchase something, I receive some materials here. Either you call it as a stock or inventory, or it can be directly purchases account. Let me make that as a purchases. Here I'm not talking about whether it is a credit purchase or a debit purchase, right? So in this case, what am I doing it? I am purchasing, assume that I am paying upfront cash. Now tell me the journal entry for the purchases that happened for the worth of, let's say 30,000. 30K purchases happened. What is the journal entry for this purchases? 30,000
Purchase
in what?
account debit,
Purchases debit.
cash account credit.
Very good. And cash credit because cash is going up here again. Okay, same thing happens, 30,000. I'm not just adding a dollar sign, but still assume these are all in dollars. Okay, this is how you make sure debit is matching with your credit. Always it has to be equal. It can be multiple entries also. If you have a tax, still the tax amount has to be matched with your debit. Okay, now the third entry, similarly, we are selling goods. Whenever I'm selling goods, let's say I'm selling for 50,000. So what should be my journal entry? 50,000 in what I'm putting it. Now entry would be good. Let's say this is the cash sales. Yeah.
A cash account debtor to sales account credit.
Okay, cash account data because we are receiving the cash because of the sales that I'm making. Okay. So let's say cash debit because I'm receiving 50,000 and say sales because I don't want to put customer names, from all the customers, I'm calling it as a sales. Okay. If it is a credit, you call it as a accounts receivable. Okay, as it is not credit, it is a cash amount. So I'm not going to put accounts receivable at this. Now I'm paying a rent. The next thing I have is a rent 5,000 I paid. I'll put 5,000 again here. So tell me which account to debit, which account to credit.
Rent account debit, cash account credit.
Rent account debit and cash account credit. So here I'm debiting rent because as per accounting principles, debit all expenses and losses. That's a basic fundamental rule that we do it. So I'm debiting all the expenses. Rent is an expense, it is not an income. Similarly, identify what are the other expenses. Is salary expense or an income?
Expense.
Completely think about business perspective. Don't treat any employee here or a customer as a part of a business. Salary is an expense, correct? And advertisement expense for the business, it clearly says expense. We already said it's expense. It is a very much evident. Purchase of fixed asset.
Expense.
You are spending some money, though you receive some asset here. Okay. Now stationery, whatever you are purchasing stationery, it is again another expense. And telephone expenses is another expense. Now think about this. So maybe this. Now all those expenses we are going to debit. So rent we have debited. Similarly, salary also we are going to debit. So let's say 10,000. Amount is fixed. Salary is an expense, so I'll debit salary and I'm paying cash. Okay. Now, after salary, what do I have? I have my advertisement expenses for 3,000. Advertisement expense you debit. And again cash. The next thing I have is purchase of fixed asset. Maybe I'll put this fixed asset little later. Let me complete this expenses first. Okay. Stationery I purchased for let's say 1,000 and telephone expenses 2,000. 1,000 and 2,000. Okay. Now stationery again I'm paying through cash. I'll debit my stationery and I'll credit cash. Similarly, cash account again here I'll just credit and 2,000. Now I'm done with that. Now fixed asset. How do I deal with a fixed asset? Whenever I purchase a fixed asset, what are the accounts that will impact? Which account to debit, which account to credit? So you are purchasing, let's say, a computer, right? In this case, computer, or you generally call it as fixed assets. Fixed asset debit, because asset is coming into your business. So you spent, let's say, for example, which is a 20K. The 20K is what you said. You paid in a cash. So you call that as cash account credit. This is how we need to treat. Now, whenever you are able to create the journal entries, I'll summarize one more time. So how to create all these journal entries, and I'll also tell you the basic accounting principles, how you can write the journal entries later. For now, let us see what we are doing. Now I'm able to create this many journal entries. Whenever I create a journal entries, now I need to understand how to prepare a trading account or your trial balance account. Let us see how do I create a trial balance account. Your trial balance account contains particularly the summary, or which is a statement which you prepare to understand arithmetical accuracy of your total GL balances. In this case, like I already mentioned in the below, you have multiple accounts. These are the accounts which are required to me. So out of all these accounts, which account will carry debit balance? Which account will carry credit balance? That is what we need to understand. I'll give you that list now, so we will be able to understand. Now let's say I'll put debit and I'll put credit here. Whenever I talk about capital, let's see which balance it carries. Is it a credit balance or a debit balance?
It's credit.
Capital is a credit balance here. So straight away, it will get into credit side. So it is 100K. Okay. Now purchases. Now look into the purchases. What happened? Your purchases, Whether it has a
It is
debit balance
debited.
or a credit. It has debited. Now
Debit.
get into your debit. Purchases has a debit balance. Sales always will have an opposite to your purchase. Sales has credit, right? 50,000. I'm not putting any sign here, so that straight away it is understood from debit and credit that will calculate. Okay, next thing I have is excuse me,
Rent, debit.
rent, debit 5,000. Okay, salary again,
Salary, debit.
debit 10,000. And then I have
Rent is
advertisement
debit.
expenses 3,000. Maybe fixed assets, it contains debit balance here 20K. Sorry. And stationery we have 1,000. Telephone expenses 2,000. These are all debit balances. If I make a total of this, let me keep this as 0 here. There is nothing to add there, just to make it total easy. Now, if I calculate total debits, I spent 71,000 of total debits. My credits is 50,000. Always, as a part of your fundamental accounting principle, your trial balance has to match. I mean, your trial balance also should have all the debits equals to credits, right? Only then, okay, I think something is missing. Let me extend this. So always you should have a debits equals to credit. Something is wrong, it is not matching here. Why it is not matching? Just because, let's say, we have not utilized the complete capital. There is some more capital. The closing balance of the capital that we are not calculating, or the profit that we are generating, we are not calculating at this moment. Once you calculate the profit, only then you will be able to understand what happened. Maybe whatever you purchased here, not exactly the same that you are selling. That's a different story. So generally, whenever we prepare a debit and credit, I have all these transactions. Let us check whether we missed anything. 100K is what I have here. Fine. Another 30,000 transaction of purchases. Yes, we updated. And sales 50,000, we updated. Rent 5,000. Rent 5,000. Salary is 10,000. Everything looks like we updated, but still it is not matching. Are we able to make out what is wrong here? Why we are not able to see debits equals to credit? We made the exact.
You missed that stationery account. Yeah.
Stationery is 1,000. I think stationery we have updated. That is okay because we are not making a total here. Here I just updated now, but still here we already had that 1,000. Okay, we'll come back to that. So whenever you want to prepare a trial balance, you need to understand this format. What is most important for us to know is which account carries a debit balance, which account carries a credit balance. That is the starting point for you to understand. So now, if you know how to write a journal entry, then you know how to prepare this trial balance. Now, whenever I wanted to prepare trial balance, I'll look into it. That particular account carries whether debit balance or a credit balance. Depending on that, you are going to prepare it. Now, whenever you wanted to prepare your profit and loss account or a balance sheet, this is going to be the base. From here, you are going to pick all the numbers. Now, let us start generating our profit and loss account and calculate some profit or a loss. How did our business do? Now, let's say whenever you wanted to prepare a profit and loss account, or you call this as income statement. Either you call profit and loss account or an income statement. Okay. For the period ending May 2025. This is how you prepare it. Also, you add these things based KNR Ignite Solutions, profit and loss account or income statement. Only one name you use it, but I'm using both the names here for everything. So, profit and loss account statement for the period ending May 2025. Whenever I talk about it, now you need to start thinking about how to prepare your financial statements. So you don't need to be an expert, but you should be able to understand what is happening whenever we talk about it. First thing comes into picture here is your revenues. So let's say always we talk about revenue. What is revenue here? Your revenue is your sales. How much revenue you made, how much, that's because of the sales. It's a 50,000. Now the next thing comes into picture, that all the expenses that you have spent. Now let's say less expenses. Now you need to reduce all the expenses that you have spent. Okay. Now what are the expenses that you have incurred? Now let me list it out. Let's say, let me highlight all this. Rent is expense, and salary is an expense, advertisement is an expense, fixed asset is not an expense, but we don't add this to your profit and loss account. Fixed asset is going to have an impact for more than 1 year, which gives you benefit for more than 1 year, right? Generally, the assets which gives a benefit for more than 1 year, we don't include them in profit and loss account. Now, rent you paid for only for a last month. You need to pay again this month as well. In such case, these expenses we record in profit and loss account because that is only for that period it happened. Wherever there is a benefit for more than 1 month, you can't restrict and put only for that month. Asset you purchased, though you spent a huge money, you can't record that in a profit and loss account. So I don't want to add my laptop or a computer that I purchased into as an expense. So I'll treat that in my balance sheet directly. So stationery is what I spent. So maybe let me highlight this. Stationery and telephone expenses. These are the expenses that you have spent. So what happens to your purchases? Purchases is also an expense. You spend some money, you purchase some materials. That is only for that period. So this stock you already sold here for a 50,000. You are not going to retain this as for a next month stock or a next year stock. Now, these are the things that you spend. Now, whenever you prepare your profit and loss account, you first always take your revenues amount. From your revenues, let's say you made a total sales of 50,000. To achieve this 50,000, what are the things that you have spent? That is what you need to understand now. Now you put purchases. Maybe let me copy paste others. Rent, salary, advertisement, stationery, and telephone expenses. All of them I'll put it here. So now let me copy the amounts as well as it is to make it quick. Okay. Now, what is the total of this? That if I look into it, it is a 51,000. So let's say minus 51,000. So this amounts, either you can keep it for your presentation purpose. Let me put it this way. So these are your expenses. At this moment, you have your revenue less your expenses. You are literally making loss here. Sorry, did I make something wrong here? I think I made one zero. Sorry. So if I take total here, it says minus 1,000. So here minus 1,000 in the sense you are making loss. You made a 50,000 revenue. To get this 50,000 revenue, you spend 51,000, which is not a good job at all. You are already overspent for this. Okay. Either the rent you might pay more, or salary you might pay more, advertisement expenses, or whatever. Total overall expenses that you are incurring is more to generate this revenue. Businesses, what they will take care, what they will make sure. Next time, if I don't want to incur this losses, what am I supposed to do? I need to increase this sales. This anyway, I can't reduce. Rent, I can't reduce it. I can't pay less salary. I can't pay less advertisement expenses. Maybe possible, you will reduce it. Otherwise, you need to make sure stationery, telephone expenses, all these are necessary. What you can do is you make sure you can increase your sales. When you increase, let's say instead of 50, if you are able to make 60,000, then you already have profits here. That's a business decision anyway. Now I understood how to calculate the profit and loss. Now I'm able to calculate this total. This total I'll call it as profit or a loss. So this is how you just calculate at this moment. I will say this one loss. As you made 1,000 rupees less than your revenue. That is where you are making losses. In simple, if you wanted to calculate profit and loss account or a profit or a loss from all your transactions, always you need to think about capital, whatever you introduced, you are not going to calculate that in your P&L account. because that is going to remain for rest of the business life. For next year also you will carry forward. Okay. So for now, sure, Ed, you can leave for the day. So I think we'll see it tomorrow. Thank you.
Thank you. Thank you.
Yeah. So whenever we are calculating here, so let's say you have this expenses and whatever it is going to remain for a future, you treat them as a balance sheet item. Now you are not going to calculate them in your P&L item because these are not for a one period activity. The assets that you procured and capital that you got it, both are going to remain for the next period. Now I wanted to calculate or prepare my balance sheet similar to this, right? Now let me say, if I want to prepare a balance sheet, KNR Ignite Solutions, balance sheet, we don't say for the period ending, we say as on May 2025. When I say as on May 2025, until May 2025, whatever happened earlier in the past, I'm going to include everything. First thing comes into this is assets, and other side you will have a liabilities. So assets and amount, your liabilities and amount. Okay. So whenever I'm calculating this, let's understand how do I calculate my assets category. So whenever I purchase any assets, what do I do? So let's say, a second. So now the first thing what I have done in my business is I introduced a capital. The capital is your liability. Whatever you got it as in the form of capital, you need to repay to the people whoever has given this to you. Either it can be a bank, or it can be investors, or it can be your one of the family member who has given you this money for you to start the business, right? You need to repay to them. That you call it as liability. You are liable to repay to them. So that's the reason we call it as a liability. So capital is the first thing which you introduced. How much capital you introduced, that comes into picture here. Now I have introduced 100K. Let me take that 100K here. Now, always you need to calculate your retained earnings account here. You need to add retained earnings account. What amount goes into retained earnings account? Your final balance of profit and loss account. Bottom line of it. The bottom line is this year or this month, the previous month when I calculate, I incurred loss. This amount is going to carry forward to my balance sheet because profit and loss account will become zero for the period. And the next period, it is going to remain. For the next period, you start with zero. But that amount, where does it go? It goes into your liabilities in balance sheet. Now, let me say net loss, 1,000. Now my total capital is reduced by 1,000 because whatever I purchased and then I sold, finally I incurred loss. If I had made, let's say 5,000 profit, my capital should have become 150. Now as I incurred loss of 1,000, in my 100K, I lost 1,000. That is what I'm reducing it. Finally, it will become only 99K. Okay. Now let us understand. So final, your adjusted capital, it is only 99,000. You introduced 100K, but you are now with only 99K. That is your position of your liabilities. Now let me go with assets. What are the assets that I have? So my most important asset is cash. I'm not dividing this into the entire perfect structure, but we'll go deep about it later. At a high level, now let us understand how do you. Whenever I talk about cash, cash is going to be my asset. How much cash I have in my business? Here can I see my cash balance? Here I think we have not created a cash account. If I see all these cash accounts, I need to prepare a D account to know what is my cash balance. Now let's say whenever you wanted to prepare account, you prepare cash account. To know your cash account balance. All other accounts are like a straightforward one transaction. But whereas a cash, we have in a multiple places. We have a debits and credits. All of them you need to prepare here as a T account. In accounts, whenever we do it, we call this as a T account. Let me show you that how to prepare a T account. So this is how it looks like. So let me put this way. Just to give me a sec so that I'll put. You don't have too many transactions, but let me put this many. This is what you call it as a T account. This side you will have a debit. This side you will have a credits. This is how you prepare your T account. Now let me put here the cash is a debit here. What is happening? So you are putting your cash in one side. How do you calculate your total cash T account? Anybody has idea? So how to calculate now all these transactions? How do I summarize in a T format? Anybody recollect your accounting days?
Purchase account, debit.
Okay. Purchase account debit.
Cash account, credit.
So first transaction, okay, let's go with the capital transaction we have. We have cash involved here. So what is the first thing that I'm doing it here?
Cash debit or capital credit?
We have a cash debit and also capital credit here. Whenever I have this, so whenever I talk about my T account particularly, so how should I calculate? I mean, how should I bring those numbers in? Whenever you bring capital, which balance it has it here at this moment? Cash. I mean, I'm not talking about capital. Whenever you introduce the capital, because of capital introduction, what happened to your cash?
Capital
It has a debit
balance.
impact. Right? It's a debit impact. So what happens? So capital
Debit side, cash credit side.
So you have debit of 1 lakh. You are not going to write a journal entry both the side. If you write it, it will become zero balance by end of the day. But you need to calculate my cash has debited in the form of capital. Because of the capital introduction, my cash has a debit impact. That is what I'm writing it here with 100K. Now, whenever I purchase, what happened? My cash is going out, which is a credit balance. My credit balance is 30,000. So why my cash is crediting here? Because of purchases. That is what I'm writing in credit side. Now, similarly, we need to identify each transaction, which side it has an impact, whether it's a debit impact or a credit impact. Now, cash again through the sales, it has a debit impact here. Now, I will say 50,000 in a debit side because of sales. I made a sales, so I got 50,000 rupees or $50,000. Okay. That's how we need to add it. Now, let's say all other expenses on the other side, if you look into it, which will become your credit balance. If I see your rent credit balance, your salary is a credit balance, advertisement expenses are credit balance, stationery is a credit, telephone expense is a credit, and computer that you purchased is also credit. All these are credit balances. Now, let me put one by one.
Opposite entries.
So now let's say 3,000 because of my rent. The credit balance. Hope everybody is able to follow what I'm saying. Salary is another 10,000. And advertisement expenses is 3,000. Now, if I look into other ones, stationery is another 10,000. Or is it 1,000 or 10,000? Sorry, it is a 1,000. Sorry, I looked into salary and confused. Okay. Stationery is 1,000 and telephone expenses is an additional 2,000. And you purchased a fixed asset, computer. Here also you spend some cash. So computer is how much? It's a 20,000. Now, if I calculate these totals, let me put totals here. Which is a 150K. Now the difference is only, I need to calculate the difference and see what is the total difference. Here I spent 71,000 and here I have 150. Whenever I see this, let me see this if I am missing anything. 30,000 of purchases, 5,000 of your rent. Salary is at 10,000. Basically, I think your stationery is again 1,000. Telephone expenses 2,000. Okay, 1 second. Just trying to see whether I'm missing any transactions here. Can you quickly find out if I'm missing any transaction here? Looks like something is not fine.
Trial balance is not matching.
What are we missing here? So I'm just trying to see if I'm missing anything. Okay, fine. Anyway, so let's say that, let me highlight one by one. So capital introduction. Here the cash I have updated. So let me color this. Okay, so that we make sure we are covered. The purchases 30,000 done, and sales 50,000 done. The rent 5,000, yes. Salary 10,000, yes. Advertisement 3,000, yes. Stationery 1,000, yes. Telephone expenses 2,000, yes. Computer that I purchased for 20K, yes. Okay, I covered all the transactions, nothing to worry. So let's see when I make sure all the transactions are covered. This is how you are going to calculate it. Now you calculated your totals here. Let me say totals. Here you need to make sure your cash account, we need to balance it. You need to make it as a 0 by end of the period. How do you make it 0? It has to match your total debits and credit. The difference, I have a credit side here. The debit side I have top, credit side I have a less. Now here what you call this is generally, you call this as balance carry forward. You need to carry forward the balance, whatever you have the difference of that adjustment. Okay. Now let us understand my total cash balance. How much is my carry forward balance? Or you call it as carry down balance or a closing balance.
29,000.
Carry forward balance is 79,000. If I make 79,000, which will become your final balance here, right? Now it matches with 150K both sides. Now this carry down balance you are doing for a credit side. This is for the previous month. This will carry forward for the next period here. Whenever you carry forward or a brought forward balance is from the previous period, it comes here. Whatever you calculated here, it will brought down to your debit side, opposite side in your cash flow. Those who is already familiar with basics of accounting, you will be able to follow this, what I mean. So whenever you brought forward, now you say you have a debit balance of your cash. Your cash is a debit balance. Assets always should carry a debit balance. You have a more balance this side. That's the reason you have a brought forward balance of 79,000. Now your balance sheet will carry this 79,000. Whenever I prepare a balance sheet, my cash will have 79. This is how I'll calculate cash balance from the summary of all these transactions. Wherever I have more transactions like this, you need to make sure you need to calculate this way. All your T accounts. I mean, use T format accounts to calculate your account balances. This is generally we do it. Now I'm able to calculate my cash balance of 79,000. Now, what is the next thing that I have in my assets here? If I look into this, so here, if I go to my trial balance, capital is taken care. Purchases is not your balance sheet item. Sales is not balance sheet item. Rent, salary, advertisement is not your balance sheet item. Fixed asset is the one that I misread. Fixed asset is again your fixed asset. Assets, which is a 20,000. Now, if I take this balance of it, which is a 99,000. Is my assets versus liabilities matching perfectly? This is a fundamental rule in balance sheet preparation also. Always your assets equals to liabilities. This is how you need to understand balance sheet first. Everybody agree? Balance sheet always should agree with your assets equals to liabilities.
Yes.
Right? So this is a basic fundamental. Whenever you look into any business transaction, Your business is doing every day. This is what they will do. They will have the purchases, either credit purchase or a cash purchase. It's a mix of it. And they will also have a sales. They will be paying all these expenses. They will also purchase some fixed assets for their business. Business is going to prepare trial balance, profit and loss account, and the balance sheet. For them to record all these transactions as a consultant, we are going to help them to set up their system. How am I going to set up this system? That's what I need to understand. So that's the most important thing as a consultant. Now I got some basic idea. So what is journal entry at least, or to prepare a financial statements. Now those who are still not yet convinced or not yet comfortable to prepare these statements yet. So now I'll give you how to write this journal entries. You might be somebody who is coming from a non-accounting background, who might be who don't have finance and accounting working experience. Like I mentioned, one of these criteria, those who don't meet any of these criteria, now you fall under this particular category, for example. That is where I'm going to give you some clues and tips how to write these journal entries. Those who are already comfortable, maybe you can also pitch in and help me if I go somewhere wrong. Okay. Now let us see that. Whenever I wanted to prepare any journal entries, what is the basic thing that you need to understand here is, so you need to know how to write a journal entry. If I want to write a journal entry, or even before writing journal entry, let me put this way. First thing, okay, let me give you this basic accounting rules. We call it as accounting principles. So also we call it as golden rules of accounting principles, right? Either you can call it as a golden rules. Based on these golden rules, we are going to write all the journal entries. Any journal entry that you wanted to write it, you are going to prepare based on these rules. All the accounts in finance and accounts, right? Particularly, we divide them into three major categories. One is your real accounts. Real accounts is like your cash, bank, and fixed assets. These are your real accounts. And whenever you purchase or sell some goods, there will be some parties involved. You are purchasing from somebody or you are selling to somebody. Those are called your personal accounts. And there are expenses that we are spending apart from cash and bank or a fixed assets or the people that we deal with. Apart from these two, rest everything will become your nominal accounts. That is called your expenses, incomes, losses, whatever you are bringing in. Okay, nominal accounts. Now, any business transaction that you talk about it here, whatever we have listed down here, each and every transaction we should be able to identify from these transactions. We should be able to identify one of this category. If you are able to identify easily, then you are going to write a journal entry like a debit. Let me put this debit and credit. Now, as per real accounts, like I mentioned, what are real accounts? Your cash and a bank or fixed assets. Now, wherever I deal with the cash, what happened here? Now, those who comes from completely non-accounting background, no accounting experience, also will be able to answer this. Now, what happened to the cash here? So whenever there is a cash introduced as a capital introduced where I received a cash, what happened here? Whether it is a debited or a credited.
Debited.
Cash has debited. So now if I want to convert this, cash has debited because cash is coming in. Can I say that? Cash coming into my business. Now, debit, what comes in. You debit, comes in. Whatever coming in, let's say if I want to write what comes in. Opposite side, what goes out. If cash is going out, or my bank balance is going out, or my asset is going out, then I'll credit it. Now let us understand this example clearly. Now wherever cash is involved, let's see wherever cash is coming in, did I debit my cash balance? Check that. So now quickly we'll go back and verify. Is cash coming in this case whenever capital introduced? Is cash coming into the business or going out of the business?
Coming into business.
Coming into the business, that's the reason we debit it. Now one more. Whenever I purchase some material from a vendor, I need to make a payment to the vendor. Think that you paid cash. It is not, what do you say, credit purchase that you did. It's a cash purchase. Whenever you purchase some material, you paid a cash, just like your cash on delivery, or you paid before you goods got delivery. Now, is cash going out for the purchases or coming in?
Going out.
So if it is a cash going out, did we debit or a credit?
Credit.
So as per this rule, credit what goes out? Is that clarifying whatever happened?
Yes.
Some more transactions for you to clarify. Sales. During the sales, you receive the money or you pay the money to somebody. You are a business. You are not a customer. Treat you as a business from a business perspective. Do you receive money when you make sales?
Yes, we will.
Right? We receive, which means coming in is cash debited. Debit what comes in. Now, credit what goes out. As a rent you are paying is cash going up. Salary you are paying to your employees. Don't think you are receiving a salary. You are paying salary to your employees, which means cash is going out. Advertisement expenses, you are paying out. Cash going out. Okay. Stationery. Stationery is coming in, cash is going out. Okay. Telephone expenses. There is no expenses will coming in, that we'll talk later. But cash you are spending, which is a going out. So credit. Computer. Here, asset is a coming in. What comes in? Asset is coming in. What goes out? Cash is going out. Does that make sense here? What comes in, what goes out? Why we are talking about that? Now, talk about nominal accounts, for example. I'll come back to the personal accounts later. In this example, we haven't quoted any personal expenses. That's the reason I don't have a personal accounts there. Nominal accounts. Nominal accounts is all your expenses, losses, or gains or incomes. These are the four categories we have it. Now, for me to understand expenses and losses, nominal accounts. So let me pick some expenses. So now let's say, where is my journal entry? Sorry. Rent is an expense for me, right? The rent account is a nominal account. Is rent
Debit
getting
all
debited?
expenses.
Debit all expenses. Similarly, rent is my expense. Salary is also expense. Advertisement expense and telephone expenses. These are all my expenses, including your purchases. These are all expenses. So debit all expenses. If you look into this, all of them has been debited. Telephone expenses debited, your advertisement expense debited, salary debited, purchase account debited. Is that clear for everyone now? So which account we are debiting? Debit all expenses and losses. This is the basic rule that we do. As a part of credit, what do we do? So all incomes and gains, other side. Whenever you have any gains, like your revenue, sales, if you look into the sales, is a revenue for it. Here is my sales. Here is my sales. The sales account is also a nominal account. This has a credit balance. It is a coming in, right? So thus, as part of the sales, it is an income. Whenever there is an income or a gain that you record under personal account, let's say you sold to person X or you sold to person Y, then those personal accounts comes into picture. Here, as a part of your personal accounts, generally what happens? Debit the person whoever is receiving. So let me call it as receiver. Debit the receiver and we call it as credit the giver. Let's say some example. Anybody wanted to give one simple example for everybody to understand? For this debit and credits, for a personal account particularly. Okay, let's say that as a part of business, what you are doing it, you are saying about person whoever receiving is a debit. Now here we made a sales here. Whenever you make a sales, there is a somebody who receives something. Let's say here, the customer 1, customer 2, customer 3, vendor 1, vendor 2, vendor 3. Let's say this, whenever I'm purchasing something, whenever I wanted to write a journal entry, first what I'll write, I don't write purchase account or sorry, I don't want to write directly cash purchases. Whenever I'm dealing with a credit, the people also comes into picture. Now I am purchasing on a credit from a vendor one. So purchased on credit from vendor one. Whenever I purchase, what is the journal entry that we write generally on a credit basis? I'm not paying any cash.
Vendor account debit to purchase account.
Vendor one,
And purchase.
debit,
Purchase account to creditor account.
purchases account we are talking about. Okay, whenever you purchase something on a credit basis, your purchases always debit and vendor will become credit because you are purchasing on a credit basis. Now you are not paying. You are creating a liability. Vendor is going to credit and purchases account always debits. Debit, what comes in whenever you purchase something, material is coming in, but there is nothing going out. You are not paying cash. It is a credit basis. That's the reason to whom you need to make. So this is the person, whoever is giving a goods to you. Vendor is giving a good, so you are creating it. Now, whenever you make a payment entry, here you make a cash payment here. Now, let's say vendor account, vendor is receiving, person vendor one is receiving the cash because you are making a payment now. This during a payment. Whenever you make a payment entry, vendor one will receive the money. As per this personal account rule, debit the receiver. Vendor one receiving cash from business. Now my account is going out. Cash debit, sorry, credit what goes out. My cash is going out and making a payment. Now let's say whenever you are purchasing for 20,000, you purchase for a 20,000. Your vendor account got created with 20,000. Whenever you are making a payment, debit that 20,000 and cash credit. Now, whenever I calculate my vendor balance, I purchased for a 20,000. I told them I'll pay you tomorrow. Then I'm paying it here by tomorrow. So when the credit and debit nullifies, the vendor balance is zero now. Now, final entry will become purchase account data to cash account. If you look into above entries, purchases, you will have exactly the same thing. Purchase account data to cash. You relate this now, whatever I'm talking about. This is my final entry that I'm talking. You see exactly the same entry that we are talking here. The vendor credit here will get nullified with this. One debit and one credit will nullify. Remaining entries is purchase account debit, cash account credit. Exactly the same. This is how you will bring journal entries. Now, as a first class, if somebody who is attending as a non-accounting background, you might find little confusing at this moment, but as and when you practice, as and when you see more, then it will make sense to you. Okay, this is how accounting cycle, where you will understand how a journal entry is prepared based on this golden rules of accounting. Now, let me summarize that cycle, what we have done so far. Now, you also can help me what we have done so far from here in accounting cycle. So then you will be able to understand whenever you are doing a configuration, you should be aware about what exactly the accounting cycle means, right? Now, let me summarize accounting cycle that we started discussing about it. In accounting cycle, what happens first? It's a business transaction. Business transactions happened first. Then what we did from those business transactions, we created journal entries. After creating a journal entry, I wanted to know particular account balance. Let's say here I have multiple transactions happened in the same account. Did I put all this in a multiple lines here, or did I summarize and put it into one? Sales and purchase. We summarize them into one, that you call it as preparing general ledger balance or ledger balances, that you call it as general ledger account. You need to prepare general ledger account balance. First, there is a business transaction happened. From there, we try to understand which account is getting debited, which account is getting credited. From all those transactions, I am preparing ledger balances to understand which account finally has what balance. Now the next thing we prepared, trial balance. This is what your business also will do in backend. When you do this configuration in a front end, they need all this to be utilized in a backend. Then we prepared P&L account, or you call this as income statement.
Balance sheet.
And finally, balance. As a part of your external financial reporting, these are the three things that we prepare. External financial reporting, whenever we talk about it, so we need these three. For us to prepare these three, we need to go through entire accounting cycle, without which you can't prepare it. Now, this is what accounting cycle it is happening in a backend. In SAP also, we'll have exactly the same steps. You don't have a different thing. First, you don't start with balance sheet. Whenever any transaction happens in a business, from here, it has to flow until the balance sheet. Going forward, as a consultant, we should be able to at least understand by looking into any business transaction, how does it flows through all these steps in these phases? How does a transaction will convert into a balance sheet item or a profit and loss account? Either it can have a P&L account impact or it can have a balance sheet. That you need to understand. Now, for us to summarize in today's class, let us take this further of your learning, whatever we discussed today, right? In tomorrow's class, what we will discuss, we'll discuss about how this accounting cycle or a flow impacts in SAP. So that slowly we'll start understanding what exactly this means. Okay. So then we will also discuss about what are the versions of SAP. So what is the current version that we are going to learn? And what is the previous version still some organizations are using in the market? What are the major differences in both the systems? We'll touch base on that. So there is something called ECC version, which is a old version. The latest version is S4HANA system. Our training is going to be completely on S4HANA. Based on S4HANA, we are going to learn our trainings. And I'll also touch base on ECC. What are the major differences in ECC system and what exactly you need to learn, including a few applications we are going to touch base. Before next class or going forward, I want you guys to focus on, if you are not familiar with whatever the topic that we discussed. So make sure you will be able to understand these things. Make sure you will list down some business transactions, at least 15 or 20, just like what we have done. Try to put a basic transactions for you to understand, right? Like I have mentioned here, some transactions in the business. You also assume your own business. You think about your own business, or you take example of any business and list those transactions first. You should be able to comfortably at least list it down and understand the transaction, capital introduction, purchase of something, purchase of material, purchase of fixed asset, sale of your fixed asset. Don't confuse at this moment. That is okay. Sale of material only. Don't sell your fixed assets at this moment. You might get confused, but we'll treat that separately. So think about how to sell your goods that you purchased. And during that phase, you will also incur a lot of expenses. How to treat those expenses, rent, salary, advertisement. There are many other expenses that we spend. You put any other small expenses that you think and list it down as a part of business transactions. Then I want you to also prepare our journal entries from above activities. Okay? From these activities, prepare journal entries. How to write a debit and credit, you will understand. From there, try to prepare financial statements. What are the financial statements we are talking about? Particularly your TB, P&L, and balance sheet. These three. If you are able to prepare this, or if you struck somewhere, that is the sign it will give you what are the areas that you need to use. Make sure you put your efforts in understanding this before we meet for the next class, or as a continuous journey in your life. As a consultant, you need to have at least some basic understanding of all these, how it works. Without understanding this, if you wanted to move further, you will have a lot of confusions. Don't struck with the confusions later, but I would recommend to clarify now itself whatever the doubts you have it. Try experimenting on this, prepare a list of all this, then we will meet tomorrow again at the same time and we'll discuss if you have any questions. Okay, let me stop here for today and let me know if you guys have any particular questions regarding so far whatever we discussed. Any questions? Yeah, Kishore, go on, please. Sorry, Kishore, I can't hear you in case you said something. All right, anyone else? Any other questions that you have?
What is the balance sheet?
Sorry, what is?
Balance sheet.
What is balance sheet? Okay, balance sheet, whenever we call a balance sheet in a accounting, right? So this is a final statement to know a company's position, where we are exactly standing. Your balance sheet will talk about what are the total assets your business carries and what are the liabilities that you have. What is liabilities again? So what are the amounts that you have to pay to other parties, like loan you have taken from a bank, you need to pay it back. You purchased something on a credit that you wanted to repay to them, right? All these payments that you wanted to repay from wherever you borrowed money, that is called your liability. All those dues is a part of your liabilities. Similarly, you might have accumulated some assets like a land, building, computers, and all other fixed assets, including your raw material, stationery, cash, whatever cash you are carrying. All this is a part of your assets. So always you will check your position where you are standing. Your business operations are there since last 10 years, 20 years, or 30 years. Because of these operations in last these many years, what is my total assets that I have from the day I started? What is my total liabilities I have from the day I started my business? This is what the solid understanding. I mean, the business wanted to know the total position, financial position of the business as on any particular given date. If I wanted to know as on today, what is my business situation, I will prepare a balance sheet and understand where I am. If I wanted to know what is my total worth of the company, I will look into the balance sheet, I will get to. If somebody wanted to invest in a company or somebody wanted to give a loan to you, they will look into your total assets and liabilities. How many assets you have? How many liabilities you already have it? They will look into it. Arya, you are saying that you have 1 crore rupees of assets. You also have a 2 crore rupees of liabilities already. How will you pay me if I give extra loan now? Already whatever loans you made, that itself you are not in a position to repay. How will you pay to me now if I give an additional loan? That is what people will think before giving a loan. Banks also does the same thing. They will also check you if you already have any loans. If somebody has applied for any personal loan or a home loan, you might have come across this. Your bank also will check whether you already have any existing loans or not. Correct? Anybody come across this? They will check your current, what is the existing loans also. Only then they will decide and tell you how much they can grant as a loan. The summary of this situation is called your balance sheet. Anybody looking into your balance sheet can understand what is your net worth, where you are currently standing. Is it a really doing good job or a bad job? They will also compare historical data, last year balance sheet, prior year balance sheet. Prior to that, maybe let's take last 5 years balance sheet and compare how is assets whether increasing or decreasing, whether their liabilities increasing or decreasing. In last 10 years, what happened? They will compare it on this. Only then we will understand where that company is exactly stands. Balance sheet is a picture of the company's financial worth. Does that give you some idea?
Trial balance sheet and balance sheet both are same or not?
Trial balance and balance sheet both are not same. Trial balance we prepare just to know whatever the transactions happened in a business so far. I just wanted to know whether all the transactions, let's say every journal entry has a debit balance and a credit balance. I mean, debit impact and a credit impact. All this will take into consideration and prepare a summary here in a trial balance. Here we have not taken a cash here. Here we need to include cash as well. If I want to take a cash balance, let's say, let me include somewhere here. Your trial balance will have a balance of your cash. What is the cash balance that we calculated here? 79,000. That 79,000 will come as a debit balance now. Now it might make sense to you. Now it looks 150K is adding together. This is what we missed earlier, if you could understand. Just to know, did I consider all the transactions or not properly? Did I write all the journal entries correctly or not? This is the statement that you prepare. This statement is called a trial balance to check all my debit should equal to credit, because every journal entry I prepared debit and credit. This 20,000 is included in a fixed asset here, if you look into this, right? And also it is included in a cash other side. Now the capital, wherever I have this 100K, I have this 100K here. The same 100K has been divided in the form of cash here in a different picture. 79 is my final cash. That is spread across these many transactions. Now to understand, did I updated everything or did I miss any transaction? This statement will tell you whether all the transactions that happened in a business are considered to calculate this or not. Now it is fine. From here, I'm going to prepare my balance sheet. For me to prepare a balance sheet, I'll use only this. All these items, whatever you see, may not be part of your balance sheet. Certain items will go into your profit and loss account. Certain items will get into balance sheet. If you look into this, purchases are not in your balance sheet. Whenever I prepare my balance sheet, there is no purchases here. There is only 4 items here. In your P&L account, this is your trial balance, right? If you look into your P&L statement here, this is your P&L statement finally. So let me put orders to this as well. Okay. This is your final P&L statement. In your P&L statement, you have a revenues and expenses only. You don't have any fixed asset recorded here. There is no capital recorded here. So from here, I can straight away use the numbers. This is a final summary place from where I can prepare my next financial statements, like your P&L account, balance sheet, and cash flow statements. You no need to refer to all these journal entries. Journal entries generally will have few lakhs of journal entries every month, which will be highly difficult for you to look into each and every journal entry and prepare your income statement or balance sheet. For you to prepare balance sheet and income statement, you refer to trial balance, which is a summary of all the journal entries. That's it.
Okay, sir. Thank you.
Oh. Any other questions? All right. If no other questions, I think considering that time as well, we'll continue to meet tomorrow and we'll discuss the remaining topics.